What's up, family? This is your boy Ivan Hall, the Credit King. Do you know what a pay for delete means? When a borrower agrees to pay off a collections account, in return for the debt collector removing the account from their credit record, this is known as pay for delete. Collection accounts usually stay on a consumer's credit record for 7 years from the date of the first delinquency. Recent accounts have a greater negative influence on your score than older accounts, thus the negative impact reduces until the account is completely removed from the consumer's report. The three main credit bureaus, Equifax, Experian, and TransUnion, are intended to get accurate and full information from collection firms. As a result, pay for delete isn't entirely legal, and credit reporting companies discourage it. Nonetheless, because the Fair Credit Reporting Act does not clearly ban pay for delete, certain debt collectors may offer it as an alternative. Pay for delete can be started by phoning the collection agency or sending a formal request letter, known as a pay for delete letter. When sending a pay for delete letter, make it clear that you're willing to pay all or part of the debt, in exchange for the debt being removed from your credit report. After that, the collection agency can determine whether or not to close the account, as requested. Unfortunately, a pay for delete letter has no legal standing. This implies that collection agencies might accept your payment while refusing to delete the account from your credit record. As a result, before sending payment, you should have written confirmation from the collecting agency that they are willing to terminate the account. Missed payments can lower your credit score, but an account sent to collections can slash your score by up to 110 points. The greater your starting score, the more points you'll most likely lose. However, keep in mind that the effect of pay for delete on a consumer's credit differs depending on the borrower's total credit profile. If a single unfavorable mark is eliminated via pay to delete, borrowers with several accounts in collections are less likely to notice a major boost in their score. However, you may see an increase if you just have one account in collections and the debt collector agrees to remove it from your credit report. Pay for delete should not be used to resolve a collection account on a consumer's credit report in general. Here are some reasons why you shouldn't rely on pay for delete to enhance your credit score. The procedure is frowned upon. The tactic operates in a gray area, as it is not outlawed by the Fair Credit Reporting Act. This is because only incorrect or partial entries may be erased from a consumer's credit report, not fully paid accounts. As a result, pay for delete letters are rarely legally binding. It's possible that the debt collector will not follow through. Often, debt collection firms are primarily interested in getting payment for the debts they have collected. As a result, a debt collector may accept your payment but refuse to have the account removed from your credit report. The account will not completely vanish. Credit bureaus can fix mistakes and disclose payoffs, but they are unlikely to remove the entire collections account. This is due to the fact that a debt collector is unable to remove bad marks left by the original creditor. It's possible that paying to erase will not improve your score. Collection accounts are treated differently by each credit score model, and some, such as FICO Score 9 and Vantage Score 3.0, ignore them altogether. Be very careful when using this technique and go get that money.